Did you know that 63% of all investors use dividend-paying stocks as part of their strategy? That's 2 out of every 3 people investing that are relying on dividends. What if we could find companies that not only pay these lucrative dividends, but also have a history of doing so for decades? Well, today we're going to do just that. We are going to look at some of the most reliable dividend stocks and dive into why they are the perfect choice for long-term investors. So make sure to stick around until the end, because I'll be sharing some of my top picks too. And hey, if you're new here, welcome. On this channel, we discuss everything personal finance and practical ways to make money. So make sure to join the family. And let's get straight into it. First, let's break down the problem here. Many investors shy away from investing in dividend stocks because they think that those stocks do incro or worse. They actually hurt your returns. But the reality is far from that. In fact, according to Bank of America research, companies that have increased their dividends over time tend to outperform their peers with flat or declining dividends. Over a 20-year period, companies with increasing dividends returned an average annual rate of 13.7% versus 9.4% for those with flat or declining payouts. That's more than 4% of difference in annual return. If you had $1,000 invested in each type of stock, after 20 years you would have around $2,600 more with the stocks that increase dividends. So not only is this strategy potentially more profitable, but it could also be less risky. Dividend increases indicate that a company is not only surviving but thriving. After all, a company wouldn't increase its dividend if it wasn't confident in its ability to sustain it. This suggests that these stocks may be more resilient during economic downturns. So now let's move on to the fun part, exploring some of the best dividend stocks that have been doing just that, paying dividends consistently for decades. First up, we have Procter & Gamble. This consumer goods giant has been paying dividends since 1890 and has increased its dividend for 67 consecutive years. That's a streak that began in 1956. The current dividend yield is around 2.5%, which is lower than many other dividend stocks. However, given the company's stability and consistent dividend growth, this is more than made up for. In the past 10 years, P&G's stock has outperformed the S&P 500 Total Return Index by a significant margin. Next is another consumer goods giant, Colgate-Palmolive. Like P&G, Colgate has been paying dividends since 1890 and has increased its dividend for 59 consecutive years. The current dividend yield is around 2.2%, but again, the company's stability and dividend growth more than make up for this. In the past decade, Colgate stock has also outperformed the S&P 500. Now let's move on to the financial sector with J.P. Morgan Chase. This banking giant has been paying dividends since 1907 and has increased its dividend for 11 consecutive years. While the current dividend yield is around 3%, it's important to note that J.P. Morgan's stock price has also grown significantly in the past decade, outpacing the S&P 500 total return. Another standout performer in the financial sector is Bank of America. This bank has been paying dividends since 1904 and has increased its dividend for 8 consecutive years. With a current dividend yield of around 2.5% and strong past performance, Bank of America is another great option for investors seeking both dividends and growth. Let's shift gears now to the technology sector with IBM. This tech giant has been paying dividends since 1916 and has increased its dividend for 26 consecutive years. Although the current dividend yield is only around 1.5%, IBM's stock price has still managed to keep pace with the S&P 500 Total Return Index over the past decade. Finally, we have another tech giant, Cisco Systems. This company has been paying dividends since 1983 and has increased its dividend for 11 consecutive years. With a current dividend yield of around 3.5% and strong past performance, Cisco is an excellent option for investors looking for a reliable dividend stock in the tech sector. Now let us take a closer look at these stocks and analyze some of the key factors that make them such great options for dividend investors. First, we'll look at their payout ratios. Payout ratio is the percentage of a company's earnings that it pays out to shareholders in the form of dividends. Generally, a lower payout ratio is better as it indicates that the company has more earnings available to reinvest in growth or to increase dividends in the future. All the stocks we've discussed have payout ratios well below 50%, indicating that they have plenty of room to grow their dividends in the future. For example, Procter & Gamble has a current payout ratio of just 53.7%, which means that after paying dividends to shareholders, they still have more than half of their earnings left over to reinvest in growth or increase dividends. Next, we'll look at the company's stability. A key factor to consider when evaluating dividend stocks is the company's stability and sustainability. After all, you want to invest in a company that will be around for years to come and continue paying dividends. All the stocks we've covered have been in business for over 100 years. They've proven their ability to adapt to changing market conditions and continue growing. even in tough economic times. This stability makes them ideal candidates for long-term investors seeking reliable dividend income. Finally, let's talk about historical performance. When evaluating dividend stocks, it's essential to look beyond just the dividend yield and payout ratio. You also want to consider the company's historical performance and growth potential. All the stocks we've covered have shown strong growth in both earnings and revenue over the past several years. This growth indicates that these companies are not only paying dividends, but they also reinvesting in themselves to ensure that they continue to grow and thrive in the future. For example, JP Morgan Chase has seen its earnings per share grow by an average of 13.5% over the past 5 years. Meanwhile, Bank of America has seen its revenue grow by an average of 7.5% over the same period. This growth trajectory makes these stocks attractive to investors looking for both dividends and capital appreciation. In conclusion, investing in dividend stocks can be a great way to generate passive income and potentially boost your returns. By focusing on stocks with a history of consistent dividend payments and strong growth potential, you can build a portfolio that can provide you with a steady stream of income for years to come. Whether you're a seasoned investor or just starting out, it's worth considering the benefits of investing in dividend stocks, and the ones we've covered today might be a great place to start. So what do you think? Will you be adding any of these dividend stocks to your portfolio? Let us know in the comments below. And hey, before you go, make sure to give this video a like and share it with your friends and family. It really helps us out and allows us to continue making great content. Also, if you haven't already, please consider subscribing to our channel. We post new videos every week on personal finance and practical ways to make money, so there's always fresh content for you to learn from. Thanks for watching, and we'll see you in the next video.